Welcome to this professional deep dive into Forex candle momentum. In the next 10 minutes, you'll learn how to read the market's pulse and trade with institutional force. Momentum is the speed and strength behind price movement. It's the engine that drives trends and the first sign that a market is about to reverse or explode. Every candle tells a story. The high, low, open, and close points are your data. But for momentum, we focus most on the body and the wicks. The candle body represents the distance between the open and the close. A larger body indicates a stronger conviction from either the bulls or the bears. Strong bullish momentum is seen when you have large green candles with minimal upper wicks. This shows buyers are pushing price higher without hesitation. Strong bearish momentum is the opposite, large red bodies with little to no lower wicks. Sellers are dominating the session from start to finish. Momentum is rarely constant. When large candles transition into small, indecisive doji candles, it's a clear signal that the current trend is losing steam. Long wicks against the trend represent rejection. If you see long upper wicks in an uptrend, momentum is being countered by selling pressure. Trading momentum is about finding expansion. Before an expansion, you often see compression, small candles squeezed into a tight range. Think of it like an elastic band being stretched. The tighter the compression, the more violent the momentum expansion will be once price breaks out. A powerful rule is the three-candle momentum build. When each candle is larger than the previous one, it confirms a high probability trend continuation. Look at this chart. The acceleration in candle size was your cue that the big players, banks and institutions, had entered the market. However, not all large candles are good. An exhaustion candle is a massive move that is significantly larger than everything else, often signaling the end. Healthy momentum is sustainable. If one candle does all the work in a single move, late traders get trapped as price quickly reverses against them. Context is everything. If price approaches a major support or resistance level with high momentum, it's more likely to break through than bounce. But if the momentum dries up exactly as price hits that level, shown by shrinking bodies, it's your signal that a reversal is highly probable. Always compare current candles to the previous ones. A large candle is only significant if it stands out from the recent average size. This relative reading is the key to identifying high probability setups. You're looking for where the energy is increasing or decreasing relative to the past. Speed is the final component of momentum. How much time did it take to cover that distance? Less time equals higher momentum and stronger conviction. If it took the bulls 20 hours to move up, but the bears erased it in 2 hours, the bears have the momentum advantage. Trade in the direction of speed. Let's focus on the Marubozu. This is a candle with no wicks, showing that the session opened at one extreme and closed at the other with zero hesitation. A Marubozu at a breakout point is the ultimate green light. It shows that institutions are aggressively entering and there's no selling pressure. To enter a trend, look for momentum discrepancy. You want a high momentum impulse move followed by a low momentum pullback. When the pullback candles are small and overlapping, it shows that the bulls are just resting and the bears have no real power to reverse the trend. Momentum is confirmed by volume. If candle size is increasing and volume is also rising, it means more traders are committing their capital to the move. Be careful if you see a large momentum candle with very low volume. This is often a low conviction move and likely to be a trap or a fake breakout. Always check multiple time frames. A single high momentum candle on the 1-hour chart is actually a full trending sequence on the 5-minute chart. Understanding this structure allows you to see the momentum developing on lower time frames before it even shows up as a large candle on the higher ones. When trading momentum, your stop loss should be placed where the momentum began. If price returns to that point, your original trade idea is no longer valid. You can use momentum to trail your stops. As long as each new candle maintains high momentum, you stay in. When candles shrink, you exit with your profits. Psychologically, momentum is hard. Beginners often jump in too late because of FOMO, right when the momentum is about to dry up. Patience is your best tool. Your goal is to identify the momentum surge early or wait for the first pullback. Never enter at the end of a massive candle that has already moved too far. The engulfing pattern is a classic momentum reversal. It shows that the new momentum has completely overwhelmed and swallowed the previous direction. On this GBP/USD chart, notice how the engulfing candle signaled the exact moment the bears lost control and the bulls took over with high momentum. The evening star illustrates the full momentum cycle. A strong push, a loss of energy at the star candle, followed by a powerful bearish reversal. See it here on EUR/JPY. The momentum died at resistance, and the next large red candle confirmed that a high momentum drop was about to begin. Gaps are the most extreme form of momentum. They show that price moved so fast during the market close that no trades could even happen in between. A breakaway gap signifies institutional aggression. This type of momentum often leads to long-lasting trends that can run for days or even weeks. While candles are your primary tool, indicators like the RSI can confirm what you see. High candle momentum usually pushes RSI into extreme zones. But watch out for divergence. If candle momentum looks strong but RSI is dropping, it's a hidden signal that the move is weak and likely to fail. The MACD is another great tool. It measures the distance between moving averages to show you if momentum is expanding or contracting in real time. When the MACD bars are growing, it's a green light to stay in your momentum trade. When they start to shrink, it's time to tighten your stops or exit. Let's summarize the 3 S's of momentum: size of the body, shadows of the wicks, and speed of the price movement. Master these 3 elements. Size shows conviction, shadows show rejection, speed shows institutional presence. Together, they give you the complete picture of market intent. A common beginner mistake is chasing parabolic moves. These are moves where momentum accelerates too fast without any resting periods. Parabolic moves are bubbles. They are unsustainable and almost always end in a sharp crash. Never trade a move that has gone vertical. Be careful of false momentum during low liquidity times, like the end of the New York session. These moves lack real institutional follow-through. Clean momentum looks like a staircase. Messy momentum looks like noise. If the chart is confusing, there is no momentum. Stay on the sidelines. Look at this real USD/JPY example. The momentum candle that broke the triangle was 5 times larger than any previous candle. This was your entry. Because the breakout had such high momentum, price didn't even look back. It reached the target in record time. Efficiency is a hallmark of momentum. The secret is confluence. Don't trade momentum in isolation. Combine it with key support levels and the overall trend for the best results. When all 3 align, like in this final example, you have a high probability, low-risk setup that every professional trader looks for. Master this alignment. Let's practice. Look at this chart. Can you spot exactly where the momentum shifted from bullish to bearish? Look closely at the bodies and wicks. Did you see it? The green candles became tiny, and then a massive red candle appeared. That was the moment the bears took absolute control. Developing an eye for momentum takes time. Keep a journal of momentum moves you see every day, even if you don't trade them. Experience is key. Over time, you'll develop an intuition for the market's energy that no indicator can replace. Be patient and keep studying the price action. As we wrap up, remember this. Trade what you see on the chart, not what you think or hope will happen. Momentum is the ultimate truth of price action. Mastering this skill is the foundation of becoming a consistently profitable trader. Take these lessons, practice them, and the results will follow. Your next steps are to backtest these concepts and try them in a demo account. Real mastery comes from seeing these patterns thousands of times. Thank you for joining this deep dive. We wish you the best of luck on your journey to mastering the Forex markets. Start trading smarter today.